Hello and welcome to day 5 of my trading journal to help me with my learning and understanding of ICT concepts. So we're having a recap of previous day's trading on the 6th of November in Market Replay, of course, the Nasdaq 100 E-mini futures, and we had a trade. We followed all of our entry requirements. And the thing that caused this trade to fail was my own predefined stop loss rather than following ICT's in his 2022 mentorship. When he discusses this entry model, he goes into detail about how the stop loss needs to be placed at an area that would invalidate this trade setup, which would be the high of the wick, the candle that created the fair value gap here. The idea being that if price comes above this level, that's actually a market structure shift high, which would then invalidate us going short. At the very minimum, it would at least need to be just slightly above the candle body, but to give the trade a fair chance to actually play out, the stop loss would need to account for price fluctuations, and then once the trade was in profit, then we could look at moving the stop loss to break even. But understanding that sometimes price, it might come up and test the mean threshold of the wick here. It's a kind of common thing that price sometimes does. So mean threshold is the middle here. So I was thinking about what I would be comfortable with my stop loss being. The reason I had it at 12 pips before is that with commissions that would be about maybe like $22, and my style of trading before was quite reckless, more sort of just hitting the buy and sell button without much thought, doing 5 or 6 losing trades in a single day. But if we're really going to be this methodical with our approach and this disciplined, then I think I can allow my stop loss to be 18 pips, which is a 50% increase. So instead of a $22 loss, that would be sort of more like closer to sort of $30 to $35. So if we had, with the caveat though, that we're only allowed to do 3 trades per week, with the worst case scenario being 3 losing trades in a week. Just over $100 of loss, with obviously with 1 micro contract. Because if we're going to be at the chart for like 3 days without taking a trade, so Friday that was an economic calendar event and non-farm payroll Friday, so we would have been on the sidelines on Friday. We monitored the whole morning session for Thursday, but it didn't meet any of our requirements to enter there, unless I'm mistaken. And so it took us 3 days just to find a setup that met all of our requirements. First we had the sell side liquidity being taken, which was these equal highs. Then we had a market structure shift, which happened once price came below here. So I guess this here is the market structure shift. Then we had our bearish order block, and we had our fair value gap, within the candle that created this order block here. And it was also within a discount. So now we're kind of combining optimal trade entry with the 2022 mentorship requirements. So we're kind of stacking quite a lot of requirements to even get in the trade. So I think we should at least give it the room it needs to actually be able to go into a profit. So yeah, we had all of that, and finally price was above the New York Open here, so it's quite a lot of things that we needed to enter, and it was actually pretty model entry. And our take profit was slightly below where price actually went to, and I think that would be a pretty good opportunity to start discussing something we haven't covered yet, which is the discount array order. So we've been talking about fair value gaps order blocks, equal lows, equal highs, and ICT refers to these as either premium or discount arrays, basically. And he even specified the order of those arrays that price will go to, or go from one to the next, or sort of seek them in that order. So let's go back to when we actually were entered into the trade with our more realistic stop loss. So this is still, most people say like a 1 to 2 risk to reward ratio would be good. I was asking for a 1 to 8 risk to reward ratio, but now I'm only asking for a 1 to 5.2, which is still like a fantastic ratio to have. So I'm thinking I'm being a bit too greedy with the ratio before. So okay, we need to like, we're in the short trade now, and we want some kind of context as to why price is going to go down, where it's going to reach to, why price might come down, and then why it might go back up. Price isn't just going to go down in a straight line. It's going to make lots of back and forth movements, which is going to be, obviously quite stressful, seeing our profits tick up and down. And we don't want to just be sort of trailing the stop loss, getting stopped out, exiting the trade, or even increasing the take profit, maybe because we're getting greedy. So the reason we're going to do this is to understand why price is going to go to where it's going to go. So we're actually looking at premium arrays now. So we're in a discount, and now price is going to seek out premium arrays. So the first one we've got here is a displacement fair value gap. So that's the first area that we can expect price to go to. Maybe do some kind of retracement once it gets to there. After it's reached there, it's then going to seek a. It's then going to seek a. Am I using the wrong? Am I looking for discount arrays? Yeah, that's right. I'm sorry. I'm looking for discount arrays for a sell. Yeah, that's why I wrote them here. Displacement fair value gap, bullish order block. So this here would be our bullish order block. I'll explain it again because it took me months to understand what an order block was. So a significant low was broken here. That's the first requirement. We can't just say an order block is anything. It has to have taken out a low that could have been viewed as support. Otherwise, we could argue that like any down close candle is an order block. And then we can look at the last series of down close candles as the order block here. Yep, so there's our bullish order block. And then finally, once it reaches the order block, we could expect another retracement before it moves into another stretch to then seek out relatively equal lows. And our equal lows would be the lows of the London session, which hasn't been, that's liquidity which hasn't been taken yet. So that's a reasonable target, and if you're a beginner, ICT would recommend going for the most safest target. Would recommend doing something like this. It's still a 1 to 2.6 risk to reward ratio, still a great trade. After that, I haven't actually written it down here, but then price would finally start seeking out like the last sort of major low or something. So I've just sort of said, okay, we've got the equal lows, then we've got the equal lows of the New York PM session as well, and I guess this level here probably be the maximum we'd expect price to reach to. Don't know why I changed this. Okay, right, that's where we've got. Was that where we had our target? Let's just do this again. I forgot where our target was. It was from the high to the low that created the market structure shift, which is there. Okay. So this is actually the lowest would really be expecting price to go, but we can anticipate that, you know, price likes to actually break through levels to take liquidity, which is why you know, we would expect price to potentially come past this level. Okay, so now that we've mapped out all of our discount array zones, now we can actually watch price with some context. Okay, it's taken the it's balanced out the displacement there, and now we can expect some sort of a retracement. It retraces back into the fair value gap where we entered, so there's another opportunity to enter the trade. So it's kind of going between these two fair value gaps. The price hangs around there a bit, it comes back up into the fair value gap again, so there's even a third opportunity to enter. Okay, once it's finished doing that, then it starts heading towards the bullish order block, which is the next area, and we're expecting price to get there and then to do, you know, either mini consolidation, maybe a little retracement again, maybe even a retracement back up here. So we're not going to start panicking once we see price going against us, which is exactly what it does. So we're in the trade now, so we won't be taking trades in the London session, but since we're in a trade and it's you know, we're gonna hold it through lunch, which wasn't really my plan, but it's just sort of what's ended up happening. So we're just holding this trade. We can anticipate maybe a little bit of consolidation through lunch. We're anticipating that price is going to reach for these lows, take this liquidity here. Okay, it does that. It taps down into there. The important thing is we keep breaking these swing lows here. Every time price comes down, I'm checking to make sure it has you know, created a new swing low. If price, you know, comes back up, comes down, fails to break this low here, then that'd be the first warning sign here. So okay, so at this point it looks like we can anticipate price reaching for the PM session lows. Now it's gone below the midnight open, so now we're considering price is actually moving into a discount. We were in a premium up here. Now we're in a discount zone where maybe it'd be more advantageous to find long positions. Doesn't mean we're going to exit the trade, but we need to keep this all in mind. Okay, as anticipated, price makes a big run on those PM session lows, and if we stayed on the sidelines for the morning session, this would be what we'd be looking for our if we wanted to be a buyer. This would be what we were waiting for all through the morning and the lunch. So but since we're in this trade, so price doesn't quite reach our target here. According to ICT, our target was supposed to be here, but I've got my standard deviation. So now we need to start deciding when is enough. Rather than just kind of guessing, we're going to just start keeping an eye on here. So we've got a low now. So if the next low that price makes fails to break this low, okay, I think that's a swing low. Let's just see if the next candle is green, we'll say that that's the swing low. Still coming down. Okay, it's made the green candle. We'll do one more candle. I'm pretty sure that's a swing low now, a big wick. And yeah, so we've got failed to break an old low, so now we're moving our stop loss to break even. You see, if we'd just been trailing the stop loss down here, we would have just been wicked out, you know. So Okay, so that's our first. Now next, now that that's been satisfied, now if an up-close candle is broken, in other words, if we get a green candle that closes above this green candle here, then we're going to be moving the take profit. Okay, let's see what we have. Oh no, shoot, we actually have a green candle being violated here. I kind of skipped forward a little bit too much. Okay, so now we're going to be moving the take profit to the previous low, and we're going to be using the body of the previous low, just to be safe. And we'll see if price can get us out. If price comes above here, that's creating a market structure shift. We're just going to be exiting at a reduced profit. Let's keep that in mind. Okay, yeah, price has created the market structure shift. So we're now out of the trade. We were actually supposed to... let's see what we were supposed to do. That was a failure to make the failure to break a low. Then we had a green candle violated, and then we had well, we actually had the market structure shift here. So yeah, we should have actually got out on this candle here. But I mean, let's be honest. You'd probably be like waiting to see, oh, okay, but maybe the next candle will be red. But so yeah, we'll go with more realistic. And look where we ended up. We ended up actually getting, we ended up actually staying in the trade and taking a reduced profit at the level where ICT would recommend us setting our take profit in the first place. Or if we'd actually just put our take profit at the PM session lows, and maybe just sort of, you know, maybe gone slightly below there. We could have taken profit there, but we had a take profit like this. So once we saw this green candle here, I think it would probably be more sensible just to get out here or something. But I think we'll put the take profit there. That's where it kind of should have been in the first place. And yeah, so I think going forward, I'm going to use the 18 pip stop loss. Let's say we hadn't taken a trade and we were just sitting on the sidelines waiting for our opportunity to be a buyer. So we'll just, yeah, we'll keep that there. Okay, so I'm not going to bother writing it down because it's going to take too long, but we'll just take note of it. So we need buy side liquidity to be taken. That's what happens here. Next, we need a market structure shift. I didn't notice this last time, but this is actually a swing high because we've had a candle with two lower wicks either side of it. If we were to zoom in onto like a 1 minute, this would be more obvious. So this is actually a swing high. As long as we get a red candle, price comes back down and then it makes another move upwards, we could justify that as a market structure shift. A little bit debatable, maybe that's not a strong enough signal, but that's sort of where things are a little bit open to interpretation, and you have to kind of lean on your experience. Next, we want a fair value gap. We've got our fair value gap here. We want that to be next to an order block. The order block is significant low broken, yes. Bearish candle prior to a rally that creates a fair value gap, which is here. Open of that is the order block. So we've got that requirement. Next entry must be within a discount. So we need, if we assume this is the high, we're going to go from the low to the high that created the market structure shift. We need the entry to be within a discount here. Finally, we need price to be below the New York midnight open, which it is. So that meets all the requirements here. I obviously missed this last time because I didn't see this as a market structure shift. So I'm going to put the entry as close to the premium discount as possible, as close to the fair value gap without actually going into the premium. And then, you know, before I would have had like a really tight stop loss or something, thinking that that'd actually save me money, but if we get stopped out, it's just going to be worse. So rather than trying to be clever and have a super tight stop loss, I'm just going to go for, you know, I'm going to try and go for, you know, the most recent obvious low. I mean, I know technically we've got our fair value gap here, we've got the low here, but I mean that's such a tight stop loss. It would kind of be better just to try and assume that, you know, this is the low. If price comes below here, that's a market structure shift. This is where the trade becomes invalidated. Ideally, we want the stop loss to be here, but we've settled on 18 pips here, and that would still give us a really good 1 to 3.4 risk to reward ratio. So there's nothing wrong with that. Then we just wait to see if we get filled. Yeah, price goes into the fair value gap. Goes in there a few times. Comes down below it. Makes an unexpected push downwards. Now, I've seen this happen a lot. You know, we want price to come into the fair value gap, and then immediately leave it. But what can happen is price can sort of create these wicks below the fair value gap, but we have to sort of try and ignore that. We say that's just kind of noise. We're really just looking at the bodies and trying to see, do the bodies violate this fair value gap, which kind of happens there. But to be honest, you just have to decide. You'd have to decide for yourself if this is a trade. I mean, we're already in the trade now, so we've got to just, you know, at this point we're like, we just have to let it play out. We know it might not do everything exactly as we want it. You know, it came into our order block here, so that kind of makes sense. You know, price, it seeks a fair value gap, then it seeks an order block, then it seeks equal lows. So, okay, once we get past some like choppy price action there, we get rewarded for holding through this uncertainty, and price goes and reaches that profit target there. So there was an opportunity to be a buyer as well as being a seller. So, you know, obviously what this has shown me is that I still need to do more testing. I'm grateful that I'm not actually in a live market right now, because you know, need to get more used to you know, putting these trades on and having some more confidence in them. But I think we're making progress by, you know, correcting this our risk parameters. You know, if the take profit was like something like this, then it would be sort of, but the thing is, all we have to do is have one. If that's a 1 to 3, now we need, after this trade, now we need like 3 losing trades in order to break even. After this one, that was a 1 to, we had 18 here, that was a 1 to 3.8 as well. So after this, we'd need like 6 to 7 losing trades in a row in order to get back to break even again. So that's why I think it's fine to have that extra risk. Okay, well, we'll wrap things up there, and thanks for watching. Let me know if you have any questions.